You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. It's Wednesday, September 22nd. Well, if you're looking for interesting real estate plays, investments, one of the best ones out there, in my opinion, least risk, is storage units, storage warehouses. And unbeknownst to me, there are several different types of them. They have evolved over the years. I always thought of the ones where you just see a fence around it and there's a bunch of garage doors and that's it. But evidently the business has become much more complex, much more sophisticated, and we're going to find out about that. In the meantime, if you got a question, shoot me an email, kl@kerrylutz.com. Right now, Andrew Abernathy is with us. Andrew has been in the storage unit business for many years now, even though he appears quite young. Andrew, welcome to the show. So what's the secret to making a lot of money in storage?
Thank you so much. I appreciate it. I think development for us has been our secret. Right now, existing facilities have been selling at a very low 4% cap rate, which, if you're looking for a steady income and a little safer because they're already established and stabilized, then that is a good route. But where we've become successful, one is development, and two is vertical integration.
Mm-hmm. So development is you acquire attractive pieces of property at favorable prices, and then development is you actually build these things yourself.
Correct. Yeah. When we look for sites, we only need about 3 acres. We've got it down to a science where we can fit about 100,000 square foot gross facility and about a 72,000 net rentable. So out of that 100,000 square feet, 72,000 square feet is what we can actually rent to people, because you have the hallways and the walls you got to subtract. Sure. And these pieces of dirt, it's all about location. Obviously everybody's told you since you're little in real estate, location, but it really is. We're willing to spend an extra 10 to 20% on a lot price wise, just to make sure we have the best locations for our facilities.
Right. So, and then you're developing it yourself. So there's contractors, et cetera, so you can lower costs that way, right?
Correct. Yeah. So we've been able to assemble over the past decade multiple operating companies to build these things roughly 10% less than our competitors. So, let's say our competitors building them for $12.5 million. By owning our own equipment dealership, our garage door dealership, our own construction company, and a few other things we've been able to acquire, we're able to build these things closer to 11. And I'd like to continue to find vertical integration to get that closer to 15 to 20% less than our.
So on your 72,000 square foot space, effectively, what do you wind up getting per square foot in rental fees or whatever you call it?
Yeah, so we shoot for $1.70 a foot or more. Obviously, $2 a foot is very attractive, and it's achievable. But that $1.70 a foot and or more, and that's per month. And with that, we're able to get our NOI on these properties on 100,000 square feet before debt service. We're able to get in that $850 to $950 a year. And at a 4% cap rate, or even a 5%, you're in that 17 to 22 million sales price once stabilized is achieved.
Right. And so what is your game here? Is it to operate these indefinitely or build them into profitable enterprises and sell them off?
Yeah, good question. So over the next 10 years, our business model, so we make money by developing, right? That's how we make money. We're good at lots, we're good at building, we're efficient. So for the next 10 years, we're probably going to be building, stabilize, and sell. And the reason is because right now we're doing about two a year of these. Next year, I'd like to be doing 3. Year after that, I'd like to be doing 4, 5, and so on and so forth. And in 10 years, I'd like to be sitting here and saying that we're doing one a month, opening one new facility every single month.
Wow. All right. Well, that's pretty ambitious. How long does it take you from approval to completion to finish these?
Yeah, so I like to be a little pessimistic or realistic so I don't get myself too excited. I think you can do it in less time, but when you go find a raw piece of dirt, you acquire it, it could take up to 12 months to get zoning and permitting. You know, obviously we've done it in less, but let's just say 12 months. Once you get that, you're ready to go put a shovel in the ground. You know, now you're talking 9 to 12 months, 10 to 12 months. And then once you go and have your CO, certificate of occupancy, after 2 years from raw dirt, industry average is 3 years to stabilization. And in storage, stabilization is 90%. That's what they consider stabilized. But by our lot selection, we've been able to cut that stabilization into a couple of years.
And what's your average occupancy rate?
Extra space storage and public storage, they're in the 94 to 96%. So usually they're a solid 3 to 6% above, industry standards, especially in these major cities.
Yeah. So what percentage of these people eventually default and lose their storage units and wind up on storage wars?
Well, I personally haven't had any yet. And I don't know what that actually percentage is. I think that's a good question. I think, so our criteria is we need 100,000 average household income in a 3-mile radius. We need 100,000 population in a 3-mile radius. And we need to be on and visible from a main thoroughfare. And the reason I bring that up is I think, when your incomes are 100,000 plus households, I think your forfeiting rate is probably a lot less, but I do not know that number. I think I'm going to look that one up.
Yeah, well, it's become a whole industry of these people looking to buy up storage units and TV shows, all that stuff. I wonder how legit it all is, whether it's viable to be picking through people's defaulted lockers. But hey, who knows?
Probably won't find me in there.
Yeah, well, hey, you never know. But you have to be open 24/7 in these places, don't you?
Don't just survive, thrive. The Financial Survival Network.
Lumina Gold, ticker symbol LUM on the Toronto Venture and LMGDF on the OTC, is yet another of legendary mining investor Ross Beaty's Lumina Group. It's advancing the largest primary gold deposit in Ecuador. The resource is estimated to contain 16.7 million ounces of gold and 2.2 billion pounds of copper. At just $7 US per ounce gold equivalent, it trades at an incredible 13% of its net present value. More good news is on the way with an updated PEA study expected in Q2 of 2020. It has unparalleled infrastructure. There's grid power to camp with plentiful, inexpensive hydropower available. It's close to 2 ports and is just 8 kilometers from a paved highway. Water is plentiful, it's at low elevation, and the closest community, which is very supportive of Lumina's effort, is just a 7-kilometer ride. With all this going for it, it's likely to follow the typical Ross Beaty formula, which means big returns to shareholders. Find out more and sign up for notifications at luminagold.com. That's Lumina, Lumina gold.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
Yeah, so we have that. The interesting thing is security is the number one focal point for clients. That's just an industry standard average, especially with these higher incomes. So yes, we've got well-lit hallways, we've got gated, we've got 24/7 gates, we've got staff on hand majority of the day, and they're about as safe as they come.
Mm-hmm. Everything's under video surveillance and everything, right? And everything's locked up. So, yeah, well, so is demand for these things increasing? How nationwide? How much is demand going up?
Yeah, so I'm targeting the major cities, and I just looked this up the other day and I thought it was interesting. So there's roughly 333 million people in the United States, and 83% of them live in major cities. They said that by 2050, there will be roughly 404 million people in the US, and 89 million people will be living in major cities. 89% of people will be living in major cities. So That's an 85 million person spread living in cities in the next 30 years. And right now across our country, the average person rents about 6 square feet per person. That's just the average. So you take that 6 times that 85, you're looking at just shy of 500 million square feet, 500 million square feet in storage needs in cities in the next 30 years.
That's amazing. Huh. Are there any areas that you would prefer to stay away from and not develop?
I let our criteria guide us, right? We need that 3-mile radius. The business is 3 miles. If you're looking to go get a hotel, you may drive an extra few miles for a Marriott. But in storage, what we've learned, and it's in the industry, is 3 miles is your clients. Nobody usually travels more than 3 miles. And I honestly think that's going to shrink down to 2 and 1 mile in the future, especially in cities. So to answer your question, we're open to anywhere. But again, we have that strict criteria of population, income, and that just naturally leads us into the larger cities.
Hey, what about real estate taxes? How do they tax these units?
So it varies. That's another good question, because you might say, well, hey, the rates are $2.30 a foot in this city, but we go and look at the taxes and they might be $200,000 plus for a facility. So for example, the one we have in Gilbert that's going to be opening doors here not long from now, our tax is probably going to be in that $120,000 to $150,000 a year, and that's a 100,000 square foot facility.
So do you stay away from higher tax areas? What's the strategy there?
It all depends on that income. We're looking for a certain return on development costs and time too. So like, for example, in California, the timeline I gave you earlier might be double and the cost might be double. So we would just have to throw that into the numbers. It really just depends on the rates, the cost to build, the time to build, and what they're worth after, based on the NOI with taxes included.
Right. And then you get really favorable tax treatment under Section 179 because you basically can write off like close to 50% of the cost of the project, right?
Correct. And we're able to do an itemized depreciation schedule, so we can take garage doors and other things and we can depreciate them out over a few years on top of that and not have to spread them over the whole building.
Yeah. Well, that's the cost segregation study, right? Yep. So, and that's been a boom for storage warehouses because from a tax standpoint, if you lever up and then you get to write off 40%, and that's gets taken off your passive income, when you have a large investment portfolio, that's what people are looking for, right?
Correct. Especially with our operating companies, we've got income at those because our equipment dealership, for example, they do, about $12 million in revenue outside of our vertical play. So they have a business outside of our own. So there's a lot of income that we don't mind having a little tax credit to help us with.
Yeah, hey, definitely. For sure. All right. Well, people want to find out more about what you're doing, Andrew, connect with you on the web, looking to get help, assistance. Where do we find you? Of
course. www.andrewabernathy.com. That's the personal page. And that'll kind of lead you to everything. Abernathy Holdings is our holding company that does all this. But I think those two things, you can get a hold of me in any way you'd like.
All right, excellent. And there's a link in the show notes to this interview on Financial Survival Network. Make sure you sign up for a free newsletter. Andrew, been a pleasure. Good luck on your future storage endeavors. We'll talk to you again soon.
Thank you so much. Appreciate it.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.